Hi, this is Steve Gorin. I'm here with my partner Laura Duncan. We're going to be talking about top 10 tactical and strategic issues for fiduciary income tax planning and returns. So first, some housekeeping. At the bottom of your screen are multiple application widgets you can use. All the widgets are resizable and movable, so feel free to move them around to get the most out of your desktop space. You can expand your slide area or maximize it to full screen by clicking on the arrows in the top right corner. If you have any questions during the webcast, you can submit them through the Q&A widget. We will try to answer these during the webcast, but if a fuller answer is needed or we run out of time, it will be answered later via email. Please know we do capture all questions. Plus, of course, you can email me or Laura. A copy of today's slide deck is available in the resource list. There's also a separate link that you can click on to download supporting materials. We encourage you to download any resources or links you may find useful. For the best viewing experience, we recommend using a wired internet connection and closing any programs or browser sessions running in the background that can cause issues. Webinars are bandwidth intensive, so closing any unnecessary browser tabs will help conserve your bandwidth. This webcast is being streamed through your computer, so there is no dial-in number. For the best audio quality, please make sure your computer speakers, or headset if you're wearing one, are turned on and the volume is up so you can hear the presenters. Some networks cause slides to advance more slowly than others. If your slides are behind, pushing F5, that's the function 5 on your keyboard, will refresh the page. You can find additional answers to some common technical questions located in the Help widget at the bottom of your screen. An on-demand version of the webcast will be available within an hour after the webcast and can be accessed through the same audience link that was sent to you earlier. This webinar is accredited in California and Illinois for 1.5 hours of general CLE credit and in Missouri for 1.8 hours of general CLE. We award CLE based on attendance for the full 90 minutes. From time to time, you'll be required to click a pop-up screen to confirm your continued engagement. So watch out, Big Brother's checking on you. We value your opinions and appreciate your participation in the course. So on slide 2, our overview is we're going to be talking about the 2017 tax law changes and guidance about them that has come out since then. We will talk about strategic income tax planning. We'll talk about integrating 2018 changes to the Uniform Principal Income Act. And we'll go through a top 10 list of tips for fiduciary income tax preparers. On slide 3, we'll also briefly talk about Code Section 199 capital A, that's the deduction for qualified business income, and other items. And I will actually be going through that in late April in another webinar in detail for a free webinar, or if you can't wait until April, 1 week from tomorrow, on February 20th, we're going to have an ACTEC AOI CLE webinar to talk about the final regulations and other 2019 guidance that's been issued. So the tax law changes also include changes to itemized deductions and electing small business trusts, which are relatively minor. So on slide 4, for the qualified business income deduction, there are phase-outs for certain things. So if you have specified service trades or businesses, in other words, businesses that the government has classified as evil, then you don't get the deduction unless you are within certain limitations. And furthermore, there are some wage limitations that can apply to limit your deduction. And if you are below certain thresholds, you don't have to worry about these issues. And those thresholds for 2018 are $315,000 for married filing jointly and $157,500 for all other taxpayers. And that's taxable income before considering the 199A deduction. And then there's a phase in of the negative consequences of these evil business limitations and wage limitations, and those that phase-in applies over a $100,000 amount for married filing jointly, or a $50,000 amount for other taxpayers. And then after you get above those, then those bad things happen to you in full force. And you can see there in 2019, I put in the threshold amounts, 321 for married filing jointly instead of 315, 167,725 for married filing separately instead of the 157.5, and 160,700 for single and head of household and trust in the state returns. So those are the thresholds for that. I didn't include my materials on that. If you want to email me, you can get my full set of materials, which do have everything on 199A. And again, you can see here, consider attending these webinars. And you can see I have a link there to the ACTEC ALI-CLE webinar.
And Steve, you may want to mention that there's references on many of these slides at the top that are to the materials that are also provided. So if you want more details on these issues, you can go to those additional materials.
Yes. Thank you, Laura. Appreciate that reminder. So slide 5. So trust and qualified business income. So if a trust receives this pass-through business income, then how does that account for? Well, if it's a grantor trust, it's disregarded. So the qualified business income and the wages and the unadjusted basis immediately after acquisition, or UBIA, of the property, that's the original cost purchase. Those are all passed through to the deemed owners. And then if you have a non-grantor trust or an estate, then the trust or estate and the beneficiaries are allocated their various items, their pro rata share of qualified business income, wages, and UBIA in proportion to their respective portions of distributable net income. And so you just figure out, if you distributed half the distributable net income, then the trust keeps half of those items, and the beneficiary gets half of those items on the K1. Going on to slide 6, the code section 199A deduction is not included in calculating D&I, so you don't have to worry about any kind of circular calculations. And the taxable income thresholds are applied separately at the trust and beneficiary levels. And for those of you who might have listened to my October webinar when I went through the proposed regulations, there are a lot of really bad attacks on trust that were in the proposed regulations. And ACTEC submitted comments that I led, and the government agreed with the large majority of what we requested. And so you'll see when you go and listen to my next webinar that you attend or read my materials that trusts are not really so badly attacked the way they were before. All right, let's go on to slide 7.
Slide 7,
Laura.
yes. So some additional changes in the 2017 tax law. We know that miscellaneous itemized deductions are disallowed through 2025, but trusts and estates can still take deductions related to their administrative expenses, because those are treated as not itemized under 67E. And now we have some limitations on state tax deductions, limited to $10,000 per year, but those are separate limitations for beneficiaries and non-grantor trusts. And also consider that property taxes for trades and businesses are not subject to that $10,000 limitation. So moving on to slide 8, there were some changes regarding electing small business trusts, which, as you probably know, are trusts which are eligible to be S corporation shareholders, and they allow a lot of flexibility. So now the law change says that non-resident aliens are permissible current beneficiaries of SBITs, and also changed the rules for charitable contribution deductions by SBIT. So if the S corporation makes a charitable deduction that flows through on a K1, the rules under 170, which are the charitable deduction rules for individuals, now apply to SBITs rather than the 642C rules, which are the traditional rules for trust and when they can take a charitable deduction. Going on to slide 9.
So the multiple trust rule, Code Section 643F provides that if you have 2 or more trusts and they're formed for evil purposes and their beneficiaries are sufficiently similar, then they may be treated as one trust. And you'll see in that on the slide, I'm quoting from the regulation, and this is the final regulation, and the final regulation pretty much just reproduces almost verbatim the statute. The proposed regulations had put in some really overreaching provisions that basically, if you ever advise your clients on taxes, you're going to get nailed. And ACTEC objected, and instead they went back to, again, requiring that you had to have a principal purpose, being the avoidance of federal income tax. So, and you can see there I have a link to ACTEC's comments. There are several ambiguities in the multiple trust rules. So what does it mean to have the same primary beneficiary or beneficiaries? In fact, the legislative history really mucks it up, really raises a ton of questions. And there are other questions. What's a principal purpose? And so if you kind of really take a fine tooth to this to try to really analyze it, the best way to really go and see what these questions really are is to go into ACTEC's comments. And then you can just, when you read ACTEC's comments, there are some elements that ACTEC was complaining about that are out, so you don't have to worry about those. And then, but the ambiguity in the statute and the proposed and the legislative history is still there. So you'll want to go and look at ACTEC's comments. Also, there is a separate anti-abuse rule under the Code Section 199 capital A qualified business income, and that's a totally different rule. Under that rule, you can have even one trust can be considered to be evil. And if that trust has as a principal purpose the avoidance of the various limitations of Code Section 199 Cap A, then what the consequence is that the trust will not be respected for purposes of the taxable income threshold. So the regulation doesn't go into much more detail than that, but I think the bottom line is that any income that went through the trust will not get the benefit of the taxable income thresholds. And the grantor will probably not get the benefit of the taxable income thresholds as well. So it kind of remains to be seen how that's actually going to be applied. So I'm probably overstating the case, but I just wanted you to be aware of it so you can go and check it out for yourself. Okay, going on to slide 10, Laura.
Now we're going to move on to some strategic income tax planning issues. We're going to talk about who is best taxed on gross income between a trust and the trust beneficiaries, the effect of the kiddie tax on rates, who benefits most from deductions and state and local income tax issues, also some non-tax issues considering the trust purposes and why it may be beneficial to not make distributions potentially. Going on to the next slide, we're going to talk about effects of decisions in early years and how that may play out in future years, flexibility in trust income taxation, planning for excess losses, and making elections under Section $45 for a trust to be taxed as an estate. So next slide. The first topic is who is best taxed on gross income. So sort of a knee-jerk reaction is often that a beneficiary, it would be better to have the beneficiary taxed on the trust income rather than keeping it in the trust. But there are some consequences to doing that. When you increase a beneficiary's AGI, it could cause some potentially negative tax issues. For example, the reduction.
And by AGI, we mean adjusted
gross income, right. So although miscellaneous itemized deductions are out until 2026, there are other deductions that might be limited as a beneficiary's AGI increases, like medical deductions and casualty losses. There could be a phase out of the AMT exemption, although the AMT exemption is now quite a bit higher. A phase out of the personal exemption, which will come back under current law in 2026. And the net investment income tax, what we refer to sometimes as the NEAT tax, which is the tax on passive income. Once an individual exceeds certain thresholds, the NEAT tax apply, and individuals' thresholds are generally higher than trusts, and we're going to talk about that in a little bit. So moving on to the next slide. One other issue to consider is whether the beneficiary potentially has loss carryovers, likely capital loss carryovers, which they could use to offset some of that income if it is allocated to the beneficiaries. Slide 14, the kiddie tax. So under the tax law from 2018 to 2025, all under an income above a certain threshold for children is taxed at the trust tax brackets. But there is no rule that coordinates those net investment income tax thresholds. In other words, children have their own thresholds, so it still may be beneficial to shift some of that trust income out to the children because they have their own tax brackets or thresholds that they can use in determining whether the net investment income tax will apply.
So basically, after about a few $1,000s, the income is going to start getting taxed at the trust rates, which means after about $15,000 grand total, it's going to be in the top bracket.
Top bracket, right?
But they would wait for the taxable income. But they have to wait till they get to $200,000 or so before the net investment income tax will kick in.
Right. And we're going to talk a little bit about those thresholds coming up. So moving on to slide 15, Steve.
Okay. So for trusts, administrative expenses are deducted what we call above their line. They're deducted in calculating the adjusted gross income, and so they're fully deductible if those are required because of being in trust. So that would include your trust income tax return prep. It would include
appraisal fees,
potential appraisal fees, and if investment advisory fees only if those fees are particular to a purpose of the trust. If they're for general investment advice, they're not above the line. If they are for a particular reason of the trust that you can really prove that this is different because it's in trust, then you could take that what we call above the line. But all the other things, miscellaneous itemized deductions, those are disallowed for trusts, and all miscellaneous itemized deductions are disallowed for beneficiaries. So even the tax prep fees are disallowed for beneficiaries. But so if you have something complicated, then put it in the trust, and you'll be able to get your tax prep fees on that. The state tax deduction. So generally, your state, the combination of your state income tax and your personal use property tax combined is limited to $10,000 for a married couple or an individual as a general rule, and the trusts also have that same limitation, $10,000. But think about if you can break up your income and you can have some that's taxed in the trust and some that's taxed to the beneficiary, Well, you can get the $10,000 state income tax deduction for what's taxed by the trust, and $10,000 that's taxed by the beneficiary. Charitable deduction limitations we're going to talk about later. Code Section 1244 allows you to take as an ordinary loss the abandonment of certain stock, and that's allowed only in individuals. It's not allowed to trust. So if you're going to have a C corporation that you're concerned about because it's to start a business or something, then you want that to be held by an individual. There's also special rules for depreciation deductions, and we might touch on that really quickly later. Going on to slide 16, state and local income tax. You want to consider the trust rate versus the beneficiary's rates. And in particular, non-resident trust can escape taxation. So for example, in the state where Laura and I live, Missouri, if the trust is created by somebody who doesn't live in Missouri, then Missouri is not going to tax it, even if it has a Missouri trustee and Missouri beneficiaries. So for that type of a trust, we might consider reinvesting the income, and then that way the trust is not, that the income is not subject to state income tax. Whereas if we had distributed it out to Missouri beneficiaries, they would be subject to Missouri income tax. So what you really need to do is look at the federal and the state income tax, and look at the trust burden versus the individual's burden.
And the state laws do vary widely about whether you're a resident or non-resident trust. So you have to look at each state as to what their particular rules are as to whether you'd be considered a resident or a non-resident trust in that particular state.
Absolutely. And another issue is, suppose you have an irrevocable grantor trust. So again, that's a trust that's outside the estate tax system, but the grantor is taxed on the income because they're the deemed owner. Then what happens is, suppose the person, for example, were an Illinois resident, and they're subject to Illinois income tax, but they move to Florida while it's still a grantor trust. And then the grantor trust status gets turned off while the grantor is a resident of Florida. Well, that's when the gift is being deemed to be made for income tax purposes. And because the person was a Florida resident at the time that the trust became an irrevocable trust, that trust is not subject to state income tax. Going on to slide 17, Laura.
So now we want to consider, are distributions to beneficiaries to shift income appropriate? And we also have to think about the trust purposes as to whether, regardless of the income tax issues, there might be other issues not to make distributions out to the beneficiaries.
Because tax is really just a cost of the trust. It's not a be-all and end-all.
Right. It's not the only thing to consider. So just put up some issues here that you want to think about, whether protecting the beneficiary from third parties is important. For example, creditors or spouses or ex-spouses, or qualifying the beneficiary for government resources is a cause that you need. Also protecting the beneficiary from themselves. They may have addiction issues. They may be spendthrifts. So just making distributions for income tax reasons, again, may not make the most sense. And also avoiding estate tax at the beneficiary's death. So again, to the extent you make distributions, they may be included in the beneficiary's estate and cause an estate tax, although now with a much, much higher estate tax exemption, that may or may not be as significant of an issue. Moving on to slide 18. We're going to talk about in a little bit capital gain distribution elections, but in the first year of a trust, often the trustee is making an election as to future years, although Steve's going to talk about other ways that capital gains can be distributed out. And turning on and off grantor trust powers, such as a swap power, can change the way the trust is taxed. So moving on to 19. Flexibility in trust income taxation. So looking at the actual trust agreement, we need to think about what kind of flexibility do we have built into the way the trust has been drafted. So support is often the standard, what we would call an ascertainable standard, so that the trust would not be included in the beneficiary's estate for estate tax purposes. But there's still some flexibility there if, depending on whether the trust provides that the trustee has to consider other resources or ignore other resources in making those support distributions. And there also potentially are welfare distribution standards, which we would consider a non-ascertainable standard and much broader in terms of being able to make distributions to a beneficiary that goes beyond what a support distribution would be, as well as a 5% withdrawal right that the beneficiary may have that could cause the trust also to be a partial grantor trust as to the beneficiary, which again would mean that part of the trust income is taxed to that beneficiary.
So going on to slide 20, planning for excess losses. During a year during the continuation of the trust, you can't pass through losses other than depreciation. And you'll notice there's a reference there to 2J11A, Romanet 2, little b, and it's something that's really kind of weird for depreciation. As long as the trust doesn't maintain a reserve for depreciation, it can pass through the depreciation deduction to the beneficiaries. So that's an exception to the general rule that you can't pass through a loss. And there's some nuances to the way the passive loss rules apply that I don't have time to go into, but you'll see the parenthetical there looking to the supporting materials. So other than depreciation, if your trust or estate's tax return comes down to a negative taxable income, you don't get to carry that forward unless it's a business loss. And if it's not a business loss, it's not carried forward, it's just totally lost. It is gone forever. It's like my darling Clementine. And another benefit to the passive loss rules, if you have business income, those will suspend losses generally, so that you don't have to worry about the excess losses. So I did mention that the only time that the beneficiary can deduct a loss, except for the depreciation, is in the final year. Now that loss that's carried through in the final year, that loss is a miscellaneous itemized deduction under the current law and administrative guidance. And so the question is really, should that be? And the government, in fact, issued a notice. I had a question about it. Am I going to comment on the impact of IRS Notice 2018-61? And what the government said is that suppose what's generating this negative taxable income in the final year, suppose those are above the line items. So, for example, suppose you have tax prep fees that are causing that loss, or some other things that are unique to the trust, or maybe it's something else, some other kinds of deductions that are not miscellaneous itemized deductions. Should the character of those losses be preserved when you have the loss on termination? And if you look at the statute and the legislative history, the government does have some flexibility in what it can allow you to do, and the government says, well, should we let you take these excess losses as based on their original underlying character rather than as a miscellaneous itemized deduction? And there's no particular time frame for when the notice is going to give us an answer. ACTEC is going to be weighing in on that and is likely going to say, oh, yeah, that's a great idea, government. You have the authority to do it, and go ahead and please do that.
Right. Please give us guidance that says we can do that. Yeah.
That's right. Exactly. Okay, so let's go on to slide 21. So another special treat we have here for trust is a revocable trust. Most of them, almost all of them, will be able to make elections to be taxed as an estate. And if the trust does make this, revocable trust does make this election to be taxed as an estate, that allows the benefits of estate income taxation, which include you can choose a fiscal year. So that can allow you to defer tax. So, for example, if the person died in February of like this month, in 2019, then you can elect to have a fiscal year from February 2019 to January 31st, 2020. And all of the 2019 income is being deferred to 2020. And then if a distribution is made, it'll be taxed to the beneficiary during the calendar year 2020. So you can defer your income tax potentially that way. May or may not be good. I'm not a huge fan of that because the IRS does match up 1099s, and 1099s are done on a calendar year basis.
Does cause some practical challenges,
yes,
shall we say.
So
yes.
as a practical matter, you need to go and reconcile your 1099s with your fiscal year stuff. That doesn't mean I won't do it. It just means that it needs to be a substantial benefit in order for me to do it. Also, charitable set-aside. So a charitable deduction for trusts is allowed for any contributions made out of gross income during the current year or during the following taxable year. But an estate gets to say, well, I'm going to distribute that gross income to charity sometime, and sometime by the time I terminate or at termination, so I get the deduction now. Then another thing is that former grantor trusts can hold S corporation stock for only 2 years before some kind of election needs to be made. Whereas if you have an estate, then you get to hold the S corporation stock for longer.
A reasonable time.
A reasonable amount. Well, it's a reasonable amount of time,
right.
but we know with the 645 election we have a hard and fast thing here, which is that election terminates 2 years after the day of the decedent's death if you didn't file an estate tax return, or if you did, then 6 months after the date of final determination of estate tax, and which is 12 months after the closing letter. Now, the IRS has said we're not going to issue a closing letter unless you ask for them. So what you can do instead is you can get a transcript from the IRS showing that there is no estate tax due. And that transcript will protect you if you make distributions. So anybody who really would like to prolong their administration, they could potentially wait until the statute of limitations has run. If they don't ask for a closing letter, they can wait till the statute of limitations has run on the estate tax return. So let's go on to slide 22, Laura.
Okay. So we're going to go on to some tips for all of you out there that are fiduciary income tax return preparers, because this is now the time of year where we're all gearing up to get these done, and some of the things that you should be thinking about as you start to prepare those returns and be strategic in your income tax planning. So we're going to talk about distributions after year end, the so-called 65-day rule to carry out income to beneficiaries. We're going to talk about capital gain elections, and even after the first year of the trust, how capital gains can still be carried out to beneficiaries in certain circumstances. Charitable distributions, and as Steve mentioned, Those can count for the current year or the immediately preceding year. Changes in the beneficiary's residence, which could change the status of a resident trust to a non-resident trust potentially. Material participation for business or rental activities, which is important with respect to the net investment income tax and whether that applies or not. Next slide. Whether we can make a trust a partial or complete grantor trust, which would cause a permanent shift of income from the trust to a beneficiary. Trapping income in trust notwithstanding distributions. So there we're talking about SBITs and how SBITs pay tax at the trust level on the S corporation income, even if that income is distributed out. And finally, ways that trusts could potentially be modified, even irrevocable trusts, to make them more income tax efficient. So next slide. One additional tip is when you're working on the fiduciary income tax returns is talking to the trustees about providing the beneficiaries annual notices so that the trustees can shorten the period of time, frankly, in which they can be sued. Steve's material has a sample notice in it, but basically you're going to want to provide adequate disclosure of the activities of the trust and also give notice to the beneficiary indicating the time allowed to commence a proceeding.
Yeah, and for example, in Missouri law, you have 5 years after termination of the trust for the beneficiary to sue.
Right, and you can reduce that to 1 year if you do those things. So
exactly.
It can be pretty significant for the fiduciary if you're able to help them with that. So next slide. So again, rough drafts of the returns, now is the time to start working on those, particularly because of the 65-day rule. If distributions are made by March 6th of this year, they could be treated as distributions of either 2019 distributions or 2018 distributions. So it's important to start roughing out the returns and comparing the beneficiary's tax rates to the trust tax rates and seeing which is more efficient. Also, those distributions could potentially carry out capital gains, as Steve is going to talk about. And I also provided a reminder about the due dates. April 15th, obviously, is the due date for most of us. There is a notation in the 1041 instructions for 2018 that says for Maine and Massachusetts, because of some holidays they have there, that is actually April 17th for those states if you have a trust or a state located there. And a couple years ago, they did change the extended due dates for 1041, so for this year, the extended due date would be September 30th. Okay, next slide, please. Okay,
so capital gain elections, we're going to get into, spend a bit of time on this, trying to get capital gains outside of the trust to the beneficiaries. So we're going to talk about the strategic issues, the law, and practical issues. But the bottom line is that tax preparation software is going to trap capital gains inside the trust unless you take special steps. So you need to not only do what you need to do to get the capital gains out to the beneficiaries, but you also have to be wary on your tax return prep program. Slide 27. So we have here the additional capital gain rates. The top capital gain rate is 20% until you get to these various levels here, and at those levels, that's when the capital gain rate will kick in, and you can see the 2019 figures that Laura so nicely plugged in for us for the taxable income. So you can notice that the trust rates, again, they're very compressed, and the top rate will kick in pretty quickly. So it's very often that distributing from a trust to the beneficiaries is going to get them not to have to pay that rate. Going to the slide 28, again, the net investment income tax. Here's the adjusted gross income thresholds, and if the adjusted gross income is above these amounts, then you may need to pay a 3.8% tax on the lesser of the net investment income or the amount by which you exceed the threshold. And for trusts, you can see that that's $12,500 for 2018, but 2019 is slipped up to $12,750. So there's a little bit different indexing for trusts for this than there is for the capital gain tax. So going on to slide 29. So most people think of it as saying that capital gains is trapped inside the trust unless you have something special occurring. And as a practical matter, that's often the answer. But that's not the way that the law reads. The statute reads, capital gain is included in distributable net income unless it's from the sale of a capital asset and the capital gain is allocated to corpus and the capital gain is not paid credit or required to be distributed to beneficiary and it's not paid, permanently set aside, or to be used for charitable purposes. So all of those conditions have to be present before you trap capital gain inside the trust. The corollary is if one of those conditions is not present, then it's included in distributable net income and can flow out to the beneficiaries. So again, the first was from the sale of a capital asset. So if it's not from the sale of a capital asset, then it's not going to be excluded and it is going to count as D&I. So going to slide 30, when is it not from a capital asset? The most common answer is Code Section 1231 property. That is property that's used in your business. So, for example, suppose you own your own building. That's where your business is done. So you own your building, you're depreciating that. Now, from a layperson's perspective, I'm investing a lot of capital in my building. So that seems like a capital asset. But from a technical tax law perspective, any assets that's used in your business is not considered to be a capital asset. So your depreciable building, that is not a capital asset. Your factory equipment, that is not considered to be capital asset. It can be a multi-million-dollar piece of equipment, not considered to be a capital asset. So when you have gain from sale of this, now if you sell equipment, that's generally going to be ordinary income because of a depreciation recapture. But if you sell a building with straight line depreciation, that is going to be capital gain. The straight line depreciation recapture is going to be taxed at a higher capital gain rate, but it's still capital gain. But even though that's capital gain, that's not the sale of a capital asset, and therefore that's not considered to be, it's not going to be considered to be trapped inside the trust. That's part of your D&I, your distributable net income. Slide 31. So what if you do have capital gain from the sale of a capital asset? Then it's going to be included in distributable net income under one of three circumstances, potentially. Allocated to income, allocated to corpus but distributed consistently, or a 65-day rule distribution. And we're going to go through each one of these in turn. So go to slide 32. Now, allocated to income, there's actually something called a power to adjust. And here's the theory behind this power to adjust. Let's suppose that we have a marital trust for the surviving spouse. Only the surviving spouse is not the parent of the decedent's children. So what you have is you have stepmom is the income beneficiary, and the children are the remainderment. So the stepmom, she's going to say, invest all for income. Everything should go into bonds, even junk bonds, because I want to maximize my income. And the remainder men, the children say, no, 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 no. My stepmom doesn't need that much income. She's the evil stepmother. Okay? You should invest all for capital gains because we are the deserving children, and you should only give to us. So kind of common sense is you really need to get a diversified portfolio. And in fact, if you invest for growth, then you may have higher future income because your assets have grown in value. So we call that a total return or a total return trust idea. And so the most common sense thing to do is to invest for total return and give a fair amount of return to the income beneficiary. So stepmom will get her fair share of the total return. She might get not just income and dividends, but maybe some of the capital gains, enough that would be a fair amount. So that way, when you invest in a diversified portfolio, a rising tide will lift all boats. Stepmom will get more distributions every year, and the kids will get more money when the trust terminates at the end. So that's the power to adjust, is we can reallocate capital gain to income. And so this the prudent investor rule that basically talks about a total return trust, and the Uniform Principal Income Act got an overhaul last year. In July of 2018, the Uniform Law Commission adopted this overhaul, which is called the Uniform Fiduciary, and boy, I have a typo here, it's Fiduciary Income and Principal Act. That's why it's UFIPA, not UFIPA. So UFIPA, and the reason is because we are now having a kind of a presumption is kind of thought of. I mean, you do want to have it's kind of like, are you going to be more income or more principal oriented? And I'm going to talk in a minute about UFIPA. But the really big deal about this is you can allocate your capital gain to income if you want in order to be fair to the income beneficiary. That's a matter of fairness. Then the question is, are you going to include that capital gain in distributable net income? Because the regulations say that you have the option of including it in income. So during the course of the year, you make your adjustment and you give her this extra money, and then when you prepare your tax return, you can decide whether that's going to carry out capital gain or not. So that's the benefit of this. It's an extremely flexible thing, as long as you stay within reasonable limits. So let's go on to the next slide, slide 33. So here's some materials for UFIPA. There's the Uniform Law Commission website. There's a web page for UFIPA. That I'm not sure that website might not change from time to time. So that's why I gave you the Uniform Law Commission's home page. But when you go to the website for UFIPA, it's got a documents type. It has an enactment kit, and that enactment kit includes mapping the Principal Income Act to its UFIPA counterparts. So you can see how the law has changed. Now, of course, UFIPA applies only if your state has adopted it. And there hasn't been time for states to even consider it yet because it just came out last July. So basically, we're going to have, state bars are going to be encouraged to form drafting committees to restate the Uniform Principal Income Act as UFIPA, and then they're going to try to, if they had any changes to the Uniform Principal Income Act, they're going to say, well, what are our policies, and how are we going to enact all of UFIPA exactly the way it is, or are we going to make some changes to it? Now, I did an ACTEC ALICLE. I was an observer to the drafting committee. The chair of the drafting committee and the reporter for the drafting committee were on this, as well as the corporate fiduciary. They were all on this panel. About half of what we say here was in that webinar. The rest was kind of more talking about some of the background and some of the policy choices that were made. But I'm here focusing on using UFIPA to save taxes, and that webinar had a little bit more than that in it. Go to slide 34. Under UFIPA, under the Uniform Principal Income Act, the original one, and under UFIPA, there's a power to adjust. But under the Uniform Principal Income Act, the trustee can adjust between Principal Income Act if the trustee invests and manages as a prudent investor. That's kind of this diversified portfolio concept we talked about. Then you have the trust terms refer to income being distributed, and the trust decides that the adjustment is necessary to fulfill the duty of impartiality. Now, UFIPA, going to slide 35, relaxed that. Instead of saying that the adjustment is necessary to fulfill the trust duty of impartiality, UFIPA says the exercise of the power to adjust will assist the fiduciary to administer the trust impartially. So it basically just has to be helpful, not necessary. So it's easier to do a power to adjust under UFIPA. And UFIPA spells out very clearly that the trustee is not liable for failing to exercise the power, and is also not liable for exercising the power as long as the decision is made in good faith. So it's a lot easier to adjust under UFIPA. So now, you can also relax your document. We'll talk about that in a little bit. Let's go on to slide 36. Here are some factors that fiduciary must consider when deciding whether to adjust or to convert to a Unitrust. And I'm not going to go through all the factors. They're there for you to read on slide 36. Also, slide 37 runs through those factors as well. Slide 38 says when you may not adjust, which is only in limited circumstances, basically to save some kind of tax issues. So go on to slide 39. Again, other times you cannot adjust. Again, this is mainly tax savings. You can see the fourth bullet point says it can't be done if it's by a fiduciary who's not an independent person. I think that that's not necessary for estate and gift tax purposes, but there were concerns from the drafters of the act, just in terms of fiduciaries abusing their power, and so that was put in as something that you couldn't do if you are accepting the state law defaults. But your trust agreement can decide to opt out of that, and the reason that you might want to do that is if you have more flexible distribution provisions. So, for example, suppose your trust says that you can distribute income and principal for a person's health, education, maintenance, support. So those are ascertainable standards. So that's not quite as flexible as the welfare. But even with ascertainable standards, there's some flexibility there. Well, because income or principal can be distributed, it doesn't really matter which it is. So who cares whether the trustee counts that as income or principal? And you shouldn't have to be an independent person to be able to make a distribution for income or to be able to make this tax election to count something as income or principal when you're having this distribution for flexible standards. So I disagree with the committee's ultimate recommendation to put that in UFIPA, but I mean, I don't think it's a horrible thing they did it, but I'm going to opt out of that for my documents. Going on to slide 40, Unitrust. So again, a Unitrust. So the power to adjust is like a year-by-year type of thing, and we'll talk about that in a moment. A Unitrust is considered to be a permanent change. So the stepmom and the stepkids are fighting it out, and they go and have a big powwow. They make a settlement. We're going to turn this into a 4% Unitrust. Every year, 4% gets distributed. So that's the purpose of the Unitrust conversion is really, I think, to avoid having to argue about what the rate needs to be every year. So you enter into an agreement and you settle on something permanent. So if the trust, if there's some tax issues that might be involved in doing the Unitrust, then it has to be in the 3 to 5% range, which is consistent with some of the regulations. But as I mentioned, the terms of a trust may write rules in whole or in part, so the trust can totally change the way these Unitrust rules are done. The trustee would adopt a Unitrust policy, including the rate and how to determine the value. So if it's 4% of assets, how do you determine those values? For example, Missouri's current statute says you take a 3-year rolling average of the values and you apply your Unitrust to that, unless the trust agreement says otherwise. And that helps smooth out the distributions. But your trust agreement can say what you want to use for that, and it can talk about whether certain mandatory or permissive rules apply, because the trust agreement controls. Slide 41. Again, the Unitrust policy can describe all these different things that are listed here. I'm not going to go into all the details here. There are some income tax issues you can also try to prescribe. The statute is flexible in what you can do. Going to slide 42. So normally the power to adjust is done annually, and the power to convert to Unitrust is a one-shot deal. But actually, when you go through the statute, you don't have to follow the norms. You can use the power to adjust and have that apply until further notice. Or you can set your Unitrust and say, this is a permanent change, but next year you can go and change your mind and change it again, because maybe some big change in circumstances has occurred that makes you want to have a different Unitrust. But from my perspective, from an income tax perspective, I will 99% of the time choose to use a power to adjust. Now, especially that you can make your power to adjust be something that applies until further notice, okay, it is similar to a Unitrust. The difference is the regulations. The regulations say if you have a power to adjust, then each year you can be inconsistent with that treatment of counting capital gains as part of D&I or not counting them as D&I. But if you have a Unitrust, the first time that you make a distribution that could carry out capital gain, you have made a permanent election. So I want to go with the power to adjust. But just be careful if you do your power to adjust that you don't make it look like it's a Unitrust. So if you do your power to adjust and it says until further notice, does that look like a Unitrust? I mean, maybe you're going to want to have your power to adjust, and then maybe in the first year, maybe the second year you say, yeah, everything for the first year still applies, I'm not going to make any changes. And maybe you just don't you just don't go into as big a deal because you're just referring back to your decision from the first year. All right, let's go on to slide 43. As I mentioned, so the trust agreement does supersede the Uniform Principal Income Act. It supersedes UFIPA. Those laws say the trust agreement can do whatever it wants. But the income tax regulations say that you cannot depart fundamentally from traditional principles of income and principal, whatever that means. Now, based on the regulations, I mean, they generally said that a 3 to 5% Unitrust is okay. And so I'm comfortable that if you keep your power to adjust or your Unitrust so that it's all within this 3 to 5% range, that will be respected. Slide 44. We're moving off now from this allocated to income exception and onto this allocated to corpus but distributed consistently. So if you allocated capital gains to corpus and you consistently count that as part of D&I, then you can continue to count that as D&I. The thing is that you have to, that the first time that you had a situation where you distributed corpus and capital gain was present, at that point you made an irrevocable election for that trust. So if you distributed capital gain out, then you made an irrevocable election. Going forward, we're always going to be distributing capital gain. If you didn't distribute capital gain, you've made an irrevocable election not to distribute capital gain, and you are stuck under this particular exception. That doesn't mean that you can't go and allocate it to income, because that's a different exception. So being stuck is only for this particular exception that you have to worry about. Now, existing trusts, again, I told you the software defaults to trapping capital gain. So most existing trusts, if they simply follow what the tax preparation software done, they've stuck themselves in with this irrevocable election to trap corpus in. Okay, going on to slide 45. Slide 45 is if you actually or were deemed to have distributed your capital gains out to the beneficiary. So you trace the actual distribution. So on day one, the trust received $100,000 capital gain. On day two, the trust distributed $100,000. That seems pretty obvious. What if it's $100,000 on day one, and the $100,000 gets distributed on day 365? That might not necessarily be so obvious from a viewpoint of tracing. However, if on day 365 you say, the trust received a $100,000 capital gain earlier in the year, I am distributing that $100,000 out, well, now you referred to it. And referring to that suffices. And this is where that 65-day rule that Laura mentioned comes into play. So anytime between now and March 6th, you can make a distribution that can count for 2018 or 2019. You don't have to make a decision when you make the distribution. You don't have to decide how you're going to treat it. You need to decide the amount of the distribution now. And then when you file the tax return, you can decide the treatment. And so you can say now, I'm distributing my capital gain out. And then when you prepare the tax return, you can decide whether to count that as included in D&I or not. You can be inconsistent from one year to the next. So that second part about that allocated to corpus and consistently treated, there are ways to get around that by using either allocated income or by referring to the capital gain when you make your distribution. And there's no regulation to say what it takes to distribute to it. So it might be as simple as the trustee emails the beneficiary and says, I'm distributing out last year's capital gain to you. So this is all the tax planning idea. What's going to work best from a tax perspective, from a pure technical tax. As Laura mentioned before, distributions may or may not be advisable or available. Now Laura is going to talk about the fairness issues of distributing the capital gain on slide 46.
Slide 46. So one of the issues is to consider is, if you're carrying this out to the beneficiary, is this going to be upsetting to the beneficiary that they're actually going to be taxed on the capital gain? For example, if they're expecting a distribution for a particular purpose, they're probably not going to be very happy when they end up getting a tax bill in addition to that. So the trustee may consider doing a gross-up distribution to cover those taxes on that purposeful distribution, and also have to consider that that gross-up payment also could cause some additional taxes. So that has to be factored in determining what's the appropriate distribution amount. But at the end of the day, even with the gross-up payment, it still may end up costing the remainderman less in overall taxes just because of how quickly the trust reaches the highest income tax brackets. So slide 47, are distributions advisable? We need to look at, again, looking at the provisions of the trust. Are distributions available? And also considering what are some of the other reasons why it may be more beneficial to keep the distributions in the trust and allow the protective nature of the trust to benefit the beneficiaries. So next slide. We talked a little bit before about a support distribution versus welfare distributions and how support would often be more limited, but there are still ways that there can be some flexibility in making distributions, and whether or not the trustee has to consider the beneficiary's other resources in determining whether a distribution should be made. Slide 49. There's also other tax issues. Again, distributions may cause an estate tax to be due by being included in the beneficiary's estate. And distributions in kind, where you're distributing actual assets, may have the benefit of causing those assets to receive a step-up in basis if they are included in the beneficiary's estate, which again, due to the high estate tax exemption, inclusion issues now are often helpful because of the income tax basis adjustment that occurs at the beneficiary's death. Slide 50. The trust can be really beneficial to the beneficiary in terms of protecting assets from creditors and spouses. If you have a beneficiary who's a spendthrift, causing those assets not to be spent unnecessarily. And even if you have a beneficiary that's a saver that doesn't have creditors, it might be one day, if they do have creditors down the road, then you may have subjected those distributions to being available to the creditors of the beneficiary. Slide 51.
Okay, so this is kind of a different approach to trying to convert capital gains to income, and there's actually kind of two elements to this. So you can form a partnership. So the trust would be a general partner, so like a 1% general partner and a 98% limited partner, and then you might give somebody else a limited partner interest, maybe a beneficiary or something else. The general partner controls everything. The limited partner just stands there with their hands out. Now going to slide 52. So when you have a partnership and the partnership has capital gains, the capital gains retain their character on the K-1, but when the partnership distributes the cash, that is considered to be income. So you don't have to use a power to adjust. It automatically converts the capital gains to income. And again, once it's in income, you have discretion how much whether to whether to count that as income or as D&I or not D&I. Another thing that you can do is if you want to try to shift income out to the beneficiary, but you don't want to give the beneficiary cash, at least not for all of it, you can give the beneficiary the limited partner interest. So the limited partner interest will it'll carry out income to the extent of the basis of limited partner interest, and so the beneficiary will pay tax on that. You'll distribute them some cash too, so they can pay the tax on it. But the bottom line is they're getting just enough cash to pay their taxes, and they're not going to be able to spend that limited partner interest. It's not like anybody's going to want to buy it from them and then beg you for distributions. So going on to so the other issue on that is that when the partnership does make distributions, though, they would be getting distributions as a limited partner. So the trustee, as the general partner, is going to be controlling distributions from the partnership, and so the trustee is still in control, even though the beneficiary who has limited partner interest has to receive a pro rata share. It's still the trustee making the distribution decisions as the general partner. So that's another way to do it. I kind of touted that a little bit more before I really got excited about number 1 and number 3 being really beneficial and being able to kind of work around number 2. So I don't see many people do that, but it is just an idea. If you don't want to have to go through the power to adjust thing, you form the partnership, and that can produce pretty good results. Okay, going to slide 53.
So ideal trust distribution provisions, as draft persons, we're thinking about flexibility and the way that we can create the most flexibility in our documents to deal with some of these income tax issues. So we use the term support in our documents to cover all ascertainable standards, education, health, maintenance support. But you could use a potentially broader definition there, something like reasonable support and comfort, that's still considered an ascertainable standard, but indicates that it's broader than just satisfying a support obligation. Even in trusts that you want to exclude from the beneficiary's estate, there can be welfare distributions by an independent trustee, which gives a lot more flexibility in terms of distributions, and also the 5% withdrawal right that we talked a little bit about before, that the trustee or potentially a trust protector, which is a concept that's gaining a lot of ground these days, could turn off before the end of the taxable year. So if the beneficiary has creditor issues, for example, that 5% withdrawal right could be turned off. Next slide. So again, if we wanted to give a welfare distribution standard, a beneficiary could appoint somebody who is not a related or subordinate party, which is a definition used under Code Section 672C. And then those distributions, you could use that welfare distributions to potentially carry out the capital gains to the beneficiary, as Steve had talked about. And a welfare standard is often helpful if you want to allow the trustee to be able to decant into a new trust that has different tax provisions potentially, and could potentially facilitate estate tax inclusion for the income basis step-up issues. And depending on what your state law says, you may need to have a welfare standard in order for the trustee to be able to decant the trust.
And one of the questions we received was, would decanting be a reason, would be something you could use to change the state income tax status? And I think it really depends on the state in which the trust was created.
Right.
Because some trusts, if you created in that state, like in Missouri, you created in the state of Missouri when you're a Missouri resident, mm-hmm. then that trust will always be subject to Missouri income tax as long as there's at least one Missouri beneficiary,
Right.
no matter where it's administered.
Right.
So decanting would not do the job for that.
Yes.
But there are other states where decanting would do the job.
Great. Okay. Next slide. Charitable distribution. So a charitable distribution by a trust reduces the adjusted gross income that's distributed to the beneficiary. And this is the exclusive way for a charitable deduction to reduce the net investment income tax. It's also more liberal than the 65-day rule that Steve talked about, in that a charitable distribution in 2019 could count as either a 2019 distribution or a 2018 distribution or contribution. But the rules do provide that the charitable contribution must come out of the trust's gross income in order for it to be deductible.
And by the way, I like putting in an inter vivos power of appointment into my trust, and I'll say when the beneficiary is of age, they can exercise that power of appointment. A lot of times they can appoint anybody but themselves. Mm-hmm. And I'll put a broad one in there, and I'll also put in that the broad one includes charities specifically, yeah. And that way the beneficiary, when they become of age, they can say, okay, I'm going to do my charitable giving through the trust, so the trust gets a direct deduction. And I, as a beneficiary, I'm not itemizing my deductions, so I don't get a benefit from the charitable deduction. So I'm doing all my charitable giving through my trust. Mm-hmm. So I'm a big believer in putting in this inter vivos power of appointment when the beneficiary becomes of age. And I'll also put it in a lot of times on my credit shelter trust, too, where I'll give the surviving spouse the ability to appoint a charity.
To charities. Mm-hmm. Okay. And reduces the net investment income tax that they would be subject to.
It reduces the net investment income tax, too. So it really has a double effect. Number one is it's a deduction that maybe the beneficiary wouldn't be taking.
Correct.
And number two is it reduces the net investment income, whereas if the beneficiary did it as an individual, that would not reduce the net investment income.
Right.
So both of those things.
Okay, next slide. We talked a little bit before about being careful to look at a change in a beneficiary's residence because it could change the status from a trust from a resident trust to a non-resident trust, which can have quite a bit of significance, because generally states do not tax non-business income earned by a non-resident trust. So as Steve mentioned, in Missouri, the trust has to have at least one Missouri resident beneficiary at the end of the year, so it's a snapshot on the last day of the tax year, in order for it to be considered a Missouri resident trust. So again, states do differ on that, but it's important to look as you're gathering information now for the preparation of your 2018 tax returns. Always check on the addresses of your beneficiaries to make sure that hasn't changed, which could change the resident status of the trust.
Okay, so
next slide, please.
On slide 57, we're going to talk just about the net investment income tax. So the net investment income tax, we know that applies to interest and dividends and stuff like that. It also applies to passive business income. And what you need to do for that is look at the trustee's participation. And there's no regulations on it. The legislative history says that a trust is considered to participate if a trustee, or if a fiduciary, in the fiduciary's capacity as such, participates in the business. And the legislative history does not say that's the exclusive remedy, the exclusive way of doing it, but that's the IRS's position. And if you can satisfy that, then the courts will definitely count you as participating. And if you can't satisfy it, well, we don't really know, because there hasn't been a court case where the taxpayer has not satisfied it. There have been 2 court cases on it. One was a Matty Carter case, and that was an unincorporated business. It was farming or something like that, and the trustee did stuff. The trustee hired a lot of people, and And the court said, get out of here, IRS. It's pretty obvious the trustee's running a business. In the Frank Aragona case, the trust owned a lot of business interests, and the trustees formed an LLC to manage those business interests. And when the trustees were managing those business interests, they were doing it in their capacity as managers of the LLC or employees of the LLC. However, the applicable fiduciary law, which is Michigan in that particular case, said that when a trust creates an instrumentality through which it acts, then any actions that a trustee takes through that instrumentality are considered to be fiduciary actions. So even though the trustees were acting as manager of the LLC, they had fiduciary responsibility because the LLC was an instrumentality of the trust. So in the Frank Aragona Trust case, because the trustees had were acting as fiduciaries when they were employees or managers of the LLC, the trust was able to count their participation, and the court found in favor of the taxpayer. Now, there's a 2013 Chief Counsel advice that says a little bit different facts. A is the trustee of a trust. A is the president of a company that the trust owns. A works in the business. A's participation does not count, according to the IRS's assertion, because A was participating as the individual president of the company, not as the trustee. Was that CCA correct? Well, there's no authority on that, one way or another, whether that CCA was correct. Now, some people will say, well, clearly the trustee had fiduciary duties because you can't take off your hat. That might be a correct answer. It might not be. It's something you would have to argue with the IRS. What I prefer to do is to change the way the corporation is run. If it's an S corporation, believe it or not, out of the 50 states and the District of Columbia, all but one allows you to change your paradigm. All but one allow you to change the paradigm so that the shareholders directly manage the company. The normal paradigm is the shareholders elect a board of directors. The board of directors appoint the officers run the company. You can get out of this paradigm and have the shareholders directly run the company. So you can, through amending the bylaws or articles of incorporation, it varies state by state what you have to do, but by doing the appropriate amendment to the appropriate document, you can let the trust as a shareholder manage it. So the trustee would manage the trust, would manage the business directly. I've set it up for clients where we have John Doe, what we sign is John Doe, trustee, CEO. And the management contract says whenever he signs that way, that means John Doe as trustee of the XYZ Trust in the trust capacity as CEO of the company. So I've done that before, and there's details in my materials about that. So that's the safe way from an income tax viewpoint. Whether you want to go through all those machinations is another thing, but I've definitely had clients who they care about avoiding this tax a lot, and they'll do it. Also, if you have Depreciation flowing through, I had mentioned before, that can pass through directly. The beneficiary's participation might help trigger getting that counted as material participation. So I'm going to kind of skip through the next couple of slides, but kind of a bottom line is that if you want to have the trustee participate in all cases if you can, because even if you have, for example, what's called a qualified subchapter S trust, where the beneficiary is the deemed owner of the K1 items, when the stock is sold, the trust is taxed on that, not the beneficiary. So you might want to have the trustee participate in case the stock gets sold. And going to slide 59, that kind of goes over that paradigm. So I'm going to skip through that. It's in the materials. Going on to slide 60, you might be able to make the trust be a partial grantor trust to the beneficiary. And the bottom line is that the trustee could exercise their discretion to declare a distribution, and then the trustee says to the beneficiary, I am now crediting your account. Here's the money. You can come and take it. Now the beneficiary has a right to withdraw, and if that right to withdraw lapses, then that might be considered to be in a future year that there was a lapse withdrawal right where the beneficiary becomes the owner. I don't know whether that works or not, but it's an idea. Slide 61, that explains basically slide 62. You can make a trust, complete grantor trust as the beneficiary by having the trust contribute all the assets as S corp, convert to QSST, and then it gets all taxed to the beneficiary. Laura, why don't you tell us a little bit more about QSSTs in just a moment or two?
Yeah, just very quickly.
Slide 63.
Slide 63, a QSST is similar to a marital deduction trust in that you have one beneficiary. All the income actually has to be distributed out, even if the trust doesn't require it to be. It actually has to go out to the beneficiary to qualify as a QSST, and there only can be one beneficiary during that beneficiary's lifetime. Next slide is regarding SBITs, which you can have multiple beneficiaries. So this is just explaining the trustee could contribute assets to an S corporation and make an SBIT election that could potentially be turned off in future years, and there's some material in here about toggling between an SBIT and a QSST if that was necessary.
Well, let us take a moment to go through this a little bit more.
All right.
So if all the income, if it's all going through the ESBT, and then the ESBT makes distributions to the beneficiary, is that going to carry out income to the beneficiary?
No.
Because
it's all trapped at the SBIT level with respect to the S corporation income.
So this kind of, we have a comparison and contrast. The QSST, all of the S corporation's income is automatically taxed to the beneficiary regardless of distributions. In the ESBT area, all the income from the S corp is trapped regardless of even if the beneficiary gets lots of distributions.
Right. So if you go to slide 65, it covers some of those issues. It can be a sprinkle trust, so there can be multiple beneficiaries, and the S corporation income is trapped at the trust level.
Yes. So slides 56 and 66 kind of talk about trying to have flexible trust design so you can decide to go in between ESBT and QSST. One thing on slide 66, we talked about an S corp. You have the estate hold on to the stock forever, at least as long as the estate is administered. There are issues on reasonable period of administration. One of our listeners talked about the old Virginia brick house case, but the bottom line is if you prolong your administration, then it's deemed not to be an estate anymore. But one of the issues for an estate or a trust holding the S corp stock is that will tend to trap the S corp stock, the S corp income inside the trust or estate at high levels. If you do a quick funding and get it out to a QSST, then you can get the income out to the beneficiaries a lot better. So you might want to do a quick funding if you can overcome liability concerns for doing that. All right, slide 67 and 68 kind of tell a little bit more about this flexible trust design. So does slide 69. So we're going to skip through that. You can look at the materials, or you can always call us and ask us later. Laura, you want to take just a moment to go through slide 70, 71?
Yep. 71, we've kind of already talked about. So on slide 70, just talking about ways that you could modify potentially an irrevocable trust to make it more income tax efficient under the Uniform Trust Code. The settlor and beneficiaries can get together and agree outside of court to modify a trust. And also we talked a little bit about decanting. In many states, a trustee could decant to a new trust that had different provisions that could potentially make it more income tax efficient. Like I said, 71, we've talked about helping the trustees get the notice out to the beneficiaries to reduce the time in which they could bring a lawsuit against the trustee.
And that cross-reference does have kind of a sample notice in there and kind of describes a procedure. But of course, need to have legal counsel make sure that they know what they're what it is. There were two other questions I'm going to answer really quickly. What's the current status of Missouri adopting UFIPA? The answer is it's too early for it to have done anything yet. But I have brought that to the attention of the chair of the appropriate bar committee, and so we'll see whether they get going on that. Another question was under that idea number 3, do you have to distribute principal equal to capital gains in order to get the capital gains out? So the answer is okay. So here's the question. So the trustee describes to encroach $10,000 to a beneficiary under HIM standard. Trust realizes $30,000 capital gain. Can the trustee treat only $10,000 of capital gains as being in D&I? And so the answer is that if you are referring to the capital gain, you can treat none, part, or all of that distribution as carrying out the capital gain. And that's assuming that is a principal distribution. And so, first of all, your distributions are going to carry out income. That always comes out first. And so only after you've carried out your income are you going to look to see whether you're carrying out principal and whether you're in this idea number 3 where you can refer to them and get them out. So that's everything. Slide 72. Again, you can get my materials by emailing me, and the materials we have for this program, I had to freeze all the cross-references to avoid cross-reference errors, so it's not as friendly to move around. So it's actually easier to round 1,800 pages than it is to move around a couple hundred pages because of this searching functionality. So you can email me for that, and you're certainly welcome to subscribe to my quarterly newsletter, and you'll get the most recent version of those 1,800 pages on a quarterly basis. Thank you for participating in our webinar. Please complete and submit the course evaluation that will be sent to you shortly. You must fill out the evaluation and submit it to receive your CLE certificate and credit. And for sure, if you have any feedback about what you would like to see next year when we do our annual fiduciary income tax webinar, then you are most welcome to do so, and we'll definitely take that into consideration next year. Otherwise, just look forward to having most of you come in and listen in to my webinar on April 23rd discussing my first quarter 2019 newsletter. Thank you very much.
Thank you.